And you're dealing with unsophisticated angels right now. And these are the lifeline for businesses raising pre-seed rounds, which is what I would call your pre-seed round, because um, the nature of VCs, like it's VCs very much look into who gave you money, because they look to defend your valuation. And so if you were valued at 10 million and it was Sequoia that gave you the money, they're like, okay, cool. Sequoia sees something here, and that's like a real indication of the market. But right now, valuation is propped up by angels that were just fighting over each other to, get involved, which is a blessing for you, and it's a benchmark. But you just have to be prepared to, like you said, defend that valuation. So yeah, I'll break down a little bit of the round. I mean, you probably know a lot of this stuff, but you usually give up 10%, or I'm sorry, usually give up 20% of your business on the seed round. So you can kind of back into what you want to raise or what valuation you have. So typically, just to give you a sense, like a real actual sense of the market right now, um, you know, we are seeing seed stage businesses raise at the revenue mark of anywhere from 250K to $1 million. Usually the businesses doing $1 million are more like sales forward types of businesses where it's like a food bev or like skin. And so they have to be generating more revenue in order to, just because of the nature of their category. But I would say businesses right now in the seed stage are raising anywhere from the those that have a path to like a venture exit are probably in the $6 to $10 million range. 10 being on the high end if you have a good amount of traction and team with chops and whatever else. And then like 8 is like, base, and 6 if you're lagging behind in terms of like say revenue. But yeah, let's see. The term lead is misleading because it implies that they go first, but they don't go first, they just go biggest.
Okay.
Okay. So usually your lead will take about 50% of your round. Okay. So if, let's say, just for simple math sake, you're raising 1.5 on 8 million. Or yeah, 1.5 on 8. So you're giving away 20% at 8 million. So a lead at that price point would come in for 500 to 750, probably 750. And they're not going to go in first though. Unless you know them for some time, or unless it's like if I were to raise a round right now, because I know the VCs for a while and we have that trust from having been on the same side of the table, or if it was a deal that you invested in prior and you just know the founder. So like the more go rounds you have with them, the more the less diligence kind of has to be conducted, and you're taking more at your word and so forth. But generally speaking, I would say, so you need to create a little bit of that buzz and narrative around your raise, which usually means having kind of industry people invested in you. It could be that. It could be so it could be like celebrity angels type of thing. So it's a mixture, and these people don't have to and don't typically invest a lot of money. I mean, this is a bizarre situation. I can count on one hand the amount of times I've heard what you went through happen.
Yeah.
So I'm sure thank the Lord and so
I,
forth, but I would thank him some more and jump up and down, because the average angel check size in reality is like 50K. Sometimes you get very wealthy because it's very risky to be in startups. And then on top of that, if you're going to put in 450 or 400, put that into a fund, then aggregates your risk over numerous companies. So for her to be in the riskiest asset class, the riskiest seed in the riskiest asset class, and then to be concentrated on one bet, that is an anomaly. So typically, savvier folks, people that just do more deals, will decrease their exposure to any one deal, and they'll come in for 25 or 50, 100 on the high end. However, what you're going for them is not necessarily, you're not looking for them to be the rainmaker. You're just looking for them to
Help
tribute around.
us up.
Yeah. Yeah. If you get Usher, if you get Kevin Hart, if you get a couple of people in talent booking, another example is if you can get a founder of a company that's been successful in this space. So I don't know if you know anyone, like any peers or people that have gone before you have raised the big rounds and sold the business in the talent booking space, or has a big, or maybe the people from what are they called? Symphony. They're like a big agency. So whatever, just like people that can bolster the narrative so that when a lead comes in, and most leads are generalists. So about 70% of seed stage funds in the US are generalists. So when a generalist VC steps in, they're looking to kind of get up to speed quickly with respect to the market, and these touch points help validate their research and help them get to speed faster.
Okay.
So they'll do their own independent research with their interns. Usually on the inside, they'll have their team conduct a market research report. We'll look at public companies and run comps to see what revenue multiple they trade at. I don't know your multiple range. So agencies typically trade at about 3x rev. When you get to, obviously you're venture back, so you're going to have you're going to be awarded a bigger multiple on your revenue. However, when you get to the exit stage, so VCs will analyze a lot the mergers and acquisition of your particular industry, like what multiples were they trading at when they got bought.
Okay.
That's what they're backing into, because then they'll say, okay, I'm investing in this business in Maven's List now at this stage, okay, and then you have to back into, okay, they need to be at 20 million revenue in order for them to start being an attractive candidate for acquisition. Assuming, let's say, you get awarded a 7x rev multiple. So at 20 million, you're looking at $140 million exit. Okay, modest for venture. I know it sounds ridiculous that 140 is modest, but just, go with me here. So, okay, 140 million, 150 million. So then the lead partner, if they're particularly excited about the deal, let's say they found a way to value at 10x rev, which it would be hard to say, but let's say 20 million, 10x multiple, you're at 200 million. So they're like, okay, cool. That exit kind of starts working for the fund, like in terms of the fund math. So how many rounds of dilution do I have to go through to set up Maven's List to go the distance? Because they know you're not going to get there off of one round of funding.
Yeah.
They're going to fund you to get to whatever milestone in order for you to raise the A and then raise the B. So let's say they'll assume 2 rounds of dilution. So they'll have a target percentage of equity that they're looking to buy. They'll dilute accordingly. And then, they're backing into, okay, then they sell at this price and this is what this investment returns. Okay. So to the extent that you could be very aware of that as a founder, I think really impresses investors, because then it shows you're not necessarily building to sell, but look, let's be honest here. It's venture capital, right? Like, this is not a slow roll cash flow distribution type of play. This is the liquidation event in the asset class. So,
Exactly.
so to the extent that you can showcase, like, hey, this is, if you can kind of let them know that you're very aware of the comps and the multiples and kind of the amount of rounds that you're having to anticipate to get there, then you start, okay, cool. And then that generalist investor they'll likely do reference calls. I wouldn't take a lead if they don't do a reference call personally. Because this lead, helps you fill out the rest of the round, and also signals downstream capital. When you go to raise your A, they'll look to see who raised your seed or who led your seed.
Who led the seed? Okay.
And so typically, the more, all you need is I like having a top tier. I mean, who doesn't? A top tier institutional, VC say this is the bet, but not all, the positive about that, the pro of that is that when you have a top tier, everyone follows almost blindly, because they have such a track record of winning that people will assuage their own doubts and say, well, I'm just going to trust, light speed. I'm going to trust base 10. There's some consumer type of VCs. So, but you don't need tier A. Tier B is excellent. Like Harlem Capital, I personally would say is probably best in class for seed stage diversity focused. I can't, like we're doing it at a high level. We have a big enough fund for us to have staff and interns and processes. And most diversity focused funds are smaller. They're at $5 to $10 million range, $15 million range, which means when you spread that across the amount of companies that they need to invest in, and then they need to reserve 30% of the fund for follow-on funding, they're really only doing 50K checks, 100K checks, which, by the way, I would tap that money too. So let's throw that into the mix of the people that you need to generate buzz. For instance, you get some diversity focused people in there. It could be HCP. HCP likes to lead. So that could be a conversation that you have when you're ready. And I would be happy to make that introduction.
Thank you.
For sure. So it could be, a diversity. You'll see people will step up to the amount of their conviction level. So they might say, okay, you know what? HCP or Backstage or, New Voices or whatever, any one of these diversity focused folks might put in 100, might put in 150. They could step up big and go 500. It kind of all depends, but you're just tapping the money that's available. You might round up 150 or 200 from angels. You might round up 150 or 200 from from diversity type VCs, and another 50 to 100 from industry people. Now you're sitting on 550, 600. So now the lead starts being very attracted at this in investing, because if they come in with 500 or 650 now, and they can walk away with the title of I led the round, which is it's kind of an ego thing. Like people want to lead rounds because it, shows that you can outcompete for deals. But now if they start looking at, okay, once we add our money into the situation, where does that get the company in terms of their round, in terms of like how complete are they? Right. So meaning it's one thing for them to lead at 650 when you have $0 raised, then you're only 50% of the way through your raise. But if you have 25 to 30% of the raise and they jump in with another 50, now you're at 80%. Now it's inevitable that the round will close pretty much, because then people that's the easiest look in the world. When you go to people and you say, hey, I got the lead, I got all these people, we're just closing this out. We're tying up some loose ends, jump in for 50. Then people, you've de-risked the seed round. So then they'll start jumping in. So, yeah, so that's the seed round deconstructed. Okay. That's the framework of the seed round. And yeah, I think you stand a great chance. I personally I would follow your gut. I wouldn't go to the market just yet, because you got to build the rev up a little bit. You got to let COVID ride out a little bit and get some of that pick kind of going back up. But I get the sense that you're very capital efficient and pretty lean. And so I think that this money, God forbid, if there was no other revenue or anything, it could probably last you damn near 2 years plus.
Exactly. And everything we're doing is making us money. Like there's no expenses right now. We're making enough to cover all of our expenses, and our money is in the bank, which is a good feeling.
Exactly. And assuming like so the thing about VC is you'll want to ramp up the spending maybe a little bit to, because you'll want to take some bets. And that's something that we've seen with bootstrap founders. When they take on VC, they leave it all in the bank and they're not fueling their growth. So there's a argument to be made for, hey, capital efficient, but at what point does capital efficient really just mean, hey, this founder is not fueling the fire? Because VC does want to see scale and growth. However, since you are pre-seed, and since
sorry.
Well, I was just gonna say, since you are pre-seed and it is a COVID climate, I'm okay with that. Be capital efficient, ride out the next year and change, and then when you start getting up on the 6 to 9, maybe a year runway, you raise with more than enough breathing room, and you'll probably close that round with some cash in the bank from your pre-seed round still. And then you can feel a little bit more comfortable ramping it up, because you'll have 2 million in the bank plus the revenue that you're making. oh my God, like that starts being an attractive target.
Wow. Thank you.
Yeah, absolutely. So I got to run to my next one, but this was great, man. I loved this call, and I loved hearing about what you're doing. I think I like how you're doing it too, man. You're doing it in your own way.
Yeah, and
And
last quick little thing. So the way that I feel like it all lined up for me is, one, I'm in the Hollywood space, and where I was putting feelers out for investment. As soon as all the nightclubs closed because of COVID, I reached out to every VIP person, and it was one of the VIP people that connected me to my investor, and those were the people
mm,
that still had cash. So all very interesting. But no, thank you so much. So is this where will you send this recording?
yeah, yeah, sure. I can send that. No doubt.
Perfect. Thank you so much. Have a great day.
Yeah, my guy. Take care, bro.
Thank
Peace.
you.